Subscribe to my channel Report Stock.
Welcome to the Deep Dive, where we cut through the noise to bring you the essential insights from the information you care about. Today, we're taking a closer look at global shipping finance. Specifically, we're using one company's latest report as a window into that world.
Yeah, we're going to unpack the second quarter and 6-month results for 2025 from C3 Inc. They're a ship-owning company listed on NASDAQ. We've got their full financial and operational report right here. Even the CEO's comments, our mission. Find the key takeaways, maybe some surprising facts, and figure out what these numbers really tell us.
Right, about the health of a company navigating, well, the high seas of commerce, quite literally.
Exactly. So C3 Inc., what do? They provide seaborne transportation, dry bulk, and crude oil. They own 4 vessels currently. 3 are handy-sized dry bulk carriers. Think versatile workhorses for things like grain or ore.
The smaller, flexible ones.
And then 1 Aframax oil tanker, the Afrapearl II. That's more for crude oil.
A decent mid-sized tanker. Altogether, the fleet capacity is over 213,000 deadweight tons. That's quite a bit of carrying power, like 200,000 cars worth of weight, just to give you a sense of scale.
Yeah, it's significant capacity.
Okay, now here's the interesting part, the puzzle we mentioned. Look at their Q2 numbers, April to June, net loss.
Not ideal on the surface.
But then, you zoom out just a bit, look at the full 6 months, January to June, net income.
Ah, okay. That's quite a turnaround.
Right. How does that happen? A tough quarter followed by a positive half year. That's what makes this interesting. What's going on behind the scenes?
Well, a big piece of that puzzle, I think, is how they actually use their fleet.
Yeah.
It's not all the same strategy. See, their handy-sized dry bulk carriers, 3 smaller ones, they operate mostly on short-term time charters.
Okay, so like leasing them out for a set period, predictable income.
Exactly. Steady cash flow. You know what you're getting pretty much day to day. It provides a baseline.
Makes sense. Stability.
But then you've got the Aframax tanker, the Afrapearl II. That one's playing a different game. It's in the spot market.
Ah, the more volatile end of things.
Much more volatile.
Huh?
Think short-term rentals versus a long lease. The potential earnings can be much higher if you catch the market right. They mention rates around $25,000 a day currently. But you also face the risk of the ship sitting idle if demand slumps or rates are too low. More risk, more potential reward.
And that mix really shows up in the numbers, doesn't it? For Q2, the quarter ending June 30th, fleet utilization was down to 78%.
Yeah, that's quite a dip from last year's 87.7%.
And the report points directly at the Aframax. It says the drop was mainly due to the commercial idle days of the Aframax tanker operating in the spot market.
So the spot market exposure bit them a bit in Q2, more idle time for the tanker.
While the time-chartered vessels had less idle time, more stability.
It really highlights that core tension in shipping, the steady income from charters versus chasing higher but riskier returns in the spot market. It explains why their overall utilization dropped and how that impacts the revenue picture for that specific quarter.
Okay, let's dig into those Q2 specifics then, because the impact is pretty stark. Revenue was $10.7 million, actually just a tiny bit down from $10.8 million last year.
So top-line revenue held fairly steady.
Right, but here's the kicker. Their daily time charter equivalent rate, the TCE rate, it plunged, down 31%.
Wow, 31%, that's substantial.
Yeah, from nearly $24,000 a day in Q2 2024 down to about $16,500 in Q2 2025. For you listening, what does a TCE drop like that really signal?
Well, the TCE rate is super critical. It's basically the ship's daily earnings after you take out voyage, cost things like fuel, port charges, canal tolls, stuff like that.
So it's a measure of core profitability per ship, per day.
Exactly. A 31% drop means the earning power of their vessels, on average, took a major hit in Q2. And as we discussed, that's mostly driven by the weaker spot market conditions affecting that Aframax tanker. It was earning significantly less each sailing day after costs.
And that weak daily earning flows right down the income statement. It led to a net loss for the quarter of $5.3 million. Even the adjusted net income, which smooths out some items, was down 62% compared to last year, landing at $1.1 million.
Ouch. Yeah, that shows the operational pressure clearly.
And on top of lower earnings per day, costs were also up. Voyage expenses jumped to $4.7 million, operating expenses to $2.4 million.
Which the report says is mostly due to having more vessels on average.
Yeah, makes sense. More ships mean more running costs, but it tightens the squeeze when TCE rates are falling, right?
Absolutely. And the report actually breaks down those costs, which is quite insightful. For voyage expenses in Q2, about half was fuel bunkers and half was port expenses.
Okay.
For the vessel operating expenses, the day-to-day running costs, over half, 54%, was crew. Then you had spares and consumables at 21% and maintenance at 13%.
So crew costs are the biggest chunk there.
Typically, yeah. And you see how, especially for the spot market tanker, higher voyage costs like fuel can really eat into profits when the charterer isn't covering them, like in a time charter. It's a constant battle managing those costs against the market rates.
So Q2, lower utilization, much lower daily earnings per ship, higher costs. A challenging picture. Which brings us back to the big question. How did C3Is manage to report a net income of $2.6 million for the full 6 months and an EPS of $0.52? That's a huge swing from the nearly $8 million loss in the first half of last year.
Right. It seems counterintuitive given the Q2 headwinds.
So what was the secret sauce? It clearly wasn't just operational performance in Q2.
No, the answer lies more on the financial management side. Specifically, deleveraging. They significantly reduced their debt.
Deleveraging, paying down debt?
Precisely. They made a big move in April 2025, settling the outstanding balance of $14.6 million for one of their bulk carriers, the Eco Spitfire. Paying off that chunk of debt had a major positive impact.
And it wasn't just that one payment. The report highlights they met all their capital spending commitments, $59.2 million for acquiring the Afrapearl II and Eco Spitfire without taking on any bank loans.
That's quite a statement. Funding major acquisitions through operations, cash, and equity offerings instead of debt.
Shows some serious financial discipline, doesn't it? Especially in shipping, which is so capital intensive.
It really does, and the impact is crystal clear when you look at their financing costs. Interest and finance costs for the first 6 months of 2025 were just $0.4 million.
Okay, $7.4 million. How does that compare?
Compare that to $1.7 million for the same period last year.
Wow. They cut their interest expenses by more than 75%.
Exactly. That massive reduction flows directly to the bottom line. It's a huge saving that significantly helped offset the weaker operational results in Q2.
That is a powerful lever to pull, but you also mentioned something about warrants earlier, a non-cash adjustment. How did that play into the 6-month profit?
Yes, that's another important, though non-operational piece. Warrants are like options for investors to buy stock later. Their accounting value changes based on market factors. In the first 6 months of 2025, C3Is recorded a gain on the value of these warrants of $0.5 million.
A gain, okay.
But in the same period last year, they recorded a loss of $15.2 million on those warrants.
Whoa, so that's a swing of nearly $16 million on paper just from how those warrants were valued.
Precisely. It's a non-cash accounting adjustment, meaning no actual cash came in or went out just from that change in Q2, but it hugely impacts the reported net income number. So the big turnaround had two main drivers: massive real cash savings from debt reduction and a significant positive swing from this non-cash warrant valuation.
Gotcha. So real financial strength combined with a helpful accounting tailwind. No wonder the CEO, Dr. Diamantis Andriotis, sounded pleased. He said, "We are fully deleveraged, thus significantly enhancing our financial flexibility."
A strong statement.
He added this position provides a strong foundation for our future growth and noted they grew the fleet capacity over 230% since starting, all without bank debt.
It suggests a strategy focused on resilience and financial stability, perhaps over rapid debt-fueled expansion. Being debt-free gives you options and staying power, especially in a cyclical industry.
Though, does being fully deleveraged maybe limit their ability to jump on really big opportunities quickly if they require significant immediate capital?
That's the classic trade-off, isn't it?
Yeah.
Less risk, but potentially less aggressive growth. They seem comfortable prioritizing the stability for now, which might be prudent given the market uncertainties the CEO mentioned.
Speaking of keeping things running, it wasn't all finance. The Aframax tanker Afrapearl II had its scheduled maintenance. It completed dry docking in August.
Right, a necessary operational event.
Took 23 days, cost about $1.3 million. That sounds like a lot of downtime and expense.
It is, but it's absolutely crucial. Dry docking is where they do major inspections, essential maintenance below the waterline, ensure the ship meets all safety and environmental rules.
So preventative maintenance on a huge scale.
Exactly. It costs money and takes the ship out of service, losing potential revenue for those days. But it prevents much bigger problems down the road and keeps the vessel safe, efficient, and legally compliant to operate and earn money long-term. A vital investment.
And looking ahead, the CEO didn't shy away from the challenges. He mentioned major changes from geopolitics, environmental rules, shifting demand, even weather.
Yeah, a whole cocktail of uncertainties facing the industry.
But he also expressed confidence, saying their performance was solid and their foundations are adaptable to this changing environment. He talked about enhancing their ability to grow core businesses and explore new ones.
It sounds like they believe their financial footing and operational setup give them the resilience needed to navigate these choppy waters. An emphasis on adaptability.
So let's wrap this up. What's the main takeaway from this deep dive into C3I's Inc.'s results? For me, it's seeing how powerful financial strategy, especially becoming debt-free, can be. It dramatically changed their bottom line, turning a potential half-year loss driven by Q2's operational dip into a solid profit.
Absolutely. The contrast between the Q2 net loss and the 6-month net income is a stark lesson in how much balance sheet management matters, not just day-to-day vessel earnings.
It really shows that financial health can provide a buffer against market volatility.
And it leads to an interesting thought, building on what the CEO said about future challenges. We see C3I's Inc. now standing jet-free. While the industry faces pressure from, say, environmental regulations requiring potentially expensive new green technologies, not to mention ongoing geopolitical uncertainty. So here's something for you to think about. How might C3I's Inc.'s fully deleveraged position give them a distinct advantage? Could this financial flexibility allow them to invest in greener ships or adapt to global disruptions more readily than competitors who are burdened with high debt levels? Their financial structure might be their biggest asset moving forward.
Subscribe to my channel Report Stock.